welcome to Banker Podcast. Today we have honor to talk to Dr. Maurizio Dallocchio, Professor of Corporate Finance at Bocconi University in Milan, Italy. He was one of key speakers of Financial Market Conference Road to Investments that was organized by Hipotekarna Banka. Conference took place on June 7th and attracted large audience. Professor Dallocchio, welcome to Banker Podcast.
It's a pleasure to be here with you today.
Thank you very much. So first question, how do insecure times affect different investments around the world nowadays?
Well, what I think is that there are some important issues to consider just to fix the concept of unsecure times as you defined it. Number one, there's an important liquidity issue. What I mean by liquidity, the fact is that, let me take the case for the United States, but in Europe the story would be exactly the same. I don't know if everybody is aware of the fact that the United States government in 2020 printed 37% out of the total dollars that are around. So basically, since the inception of the dollar, more than 1/3 of them was printed in 2020. It's an enormous dimension of liquidity. Of course, it is also an injection at the debt of that government level. But of course, this amount of liquidity, that by the way would be exactly the same if we reported the situation of EU, the situation of UK, the situation of Switzerland, the situation of Japan. And do you know why it is like that? Simply because if we take a look at inflation, you know that every currency is as any other good in the world. If you print too many banknotes in terms of dollars, and Europe does not do the same, the dollar is going to be devaluated. It didn't happen in comparison with the euro or with the pound or with other currencies around the world, just because all the central banks just kept printing currencies. Problem, what is going to happen with all this liquidity around? This is something that we do not know, and that is a typical source of uncertainty. What is going to happen in the future, we don't know, because it's the first time ever that we are facing such a situation in terms of overall liquidity available in the system. There is a second aspect that has to do with insecure times. Second aspect is the enormous correlation between the typical assets, let me say, of the past. If we think about bonds, shares, equity markets, and real estate, in the good old days, basically these assets were negatively correlated. What do I mean by that? Very simple. If bonds went up, shares went down. If real estate went up, shares went down. If shares went up, the opposite happened to other important asset classes. Nowadays, all these assets are strictly correlated. I mean, if the debt bonds issued by corporations or issued by governments, if they go down, what happens is that shares go down and real estate go down together. Why is that so? Well, the most important reason is that, shares by a number of investors worldwide are not bought on the basis of equity available to investors. Very often, shares are bought on the basis of the debt that is put together for obtaining the resources that are necessary to buy shares. What about real estate? Same thing. People get indebted to buy real estate at the end of the day. If the debt goes down, it brings together equities and real estate. This is something that didn't happen in the past. This is something new, and it's another important source of, as you mentioned, as you said, unsecure, difficult to interpret times. And then what I think is that investors should think about assets that are, I would say in the past we would call them alternative assets. Now I don't know if it is still the case for calling them alternative. What I'm thinking of is typically illiquid assets. Illiquid assets, of course, yes, of course, real estate still is there. But I would also say that arts, pieces of arts, collection of cars, collection of wines and spirits, collection of watches represent a typical alternative to investors to diversify their portfolio as a whole. I am not surprised that a number of important banks worldwide are right now offering their investors illiquid assets, just like the ones that I mentioned before, and it's becoming more and more popular. I am not saying that private investors should turn their attention to, watches or... What I am saying is that in terms of diversification, the idea of focusing on certain assets that in the past were not so popular could be a good idea.
So are there any secure investments in the capital markets today?
No. This is something that I must be very frank and sincere, and let me just say very directly a blunt no. What I am saying is, just a couple of weeks ago, I was talking to a good friend of mine. This friend of mine name is Menachem Brenner. Menachem is one of the two inventors of the VIX index. We're all, I think, popular with and familiar with the VIX index. It's the index for volatility. And we understand that volatility right now, worldwide, talking about equities, but not only these assets, volatility is not particularly high in this period. So we should not be concerned about risk. That is not the case. We should be concerned about risk. But as my friend Menachem Brenner said, the VIX index is a perfect indicator in stable times. It has also probably a predictive value because it helps interpreting what is going to happen. But if we are in stable times, what he is scared about in these months, in these semesters, is discontinuity, unexpected events that are going to have a strong, unpredictable, and devastating impact on the markets. Devastating, I'm not a pessimistic individual. Devastating means completely non-forecastable, completely out of the schemes of good investors, not able to analyze by a good, sophisticated operator of financial markets. So discontinuity is the risk that we are facing, something that is really turning the markets upside down all of a sudden. This is something that happened in the past. We do not have the need to recall the expression black swan. It can be just something that happens that we do not forecast, that we do not expect, and that has an impact on the financial markets as a whole. So no, there are no safe harbors. What I think is that investors should, at this time, take a strict look at ratings. Ratings are an important source of information for investors who want to be, if not on the safe side, completely on the safe side, at least behind a shield of something that is kind of reliable. I'm using the expression kind of reliable because, of course, investors have in mind 2008 and Lehman Brothers that went bankrupt when 15 days before they had an A+ rating. But a mistake can happen, and I'm pretty sure that rating agencies have learned a lot from the past. So a good rating is, of course, a source of a certain level of credibility and a good shield against unpredictability.
So who could expect the best return from its investments, so say?
I would say investors that are not in a hurry, investors that are not looking at the yield that is going to be generated tomorrow morning. Investors that are able to fully put in place the diversification concept. These are the key paradigms that I see for inspiring the behavior of investors that want to get a good, reliable return. So, not in a hurry, able to diversify. Open to innovation. This is also very important. We all understand that, you know, in artificial intelligence, all these instruments are based on sophisticated computer algorithms are going to influence our behavior in the future. Having said that, investors that are, of course, attracted, but not fascinated too much by innovation. One thing that I would like to put under the attention of investors is that let us take a look at the European, American, or Asian markets. You know, technological stocks are attracting the attention of all investors with the expectation of getting a super yield in the future because these technological firms might change our lives in the future. And a lot of investors are blindly allocating a lot of resources on entities that, you know, we are not completely sure that in the future will deliver our expectation. Let me take the case, and I'm pretty sure that investors have in mind what I'm talking about. Let me take the case for Tesla. Tesla, in terms of market capitalization, is worth, I would say more or less, the amount of money that Mercedes-Benz, Stellantis, Toyota, Volkswagen, all together are worth. So, market capitalization of Tesla is equal to the sum of the 7 largest car manufacturers worldwide, market capitalization. Investors, do you know what is the EBITDA of Tesla? The amount of money that is theoretically made available on an annual basis, my source is Bloomberg, so super official, is more or less 1/4 of the EBITDA that is going to be generated by Toyota alone. So market capitalization equal to even more than the first 7 car manufacturers of the world. Money produced in 2023 expected, more or less 1/4 of Toyota, a single manufacturer. Expectations for technologies are making investors, I'm not saying less sophisticated, I'm not saying with higher expectations that reality can then meet. What I'm saying is too fascinated by innovation. So good to be attracted by innovation, but not become, please do not become blind on innovation and on technological aspects. Just a final remark. I also have the perception that widening the perspective can help enhance the return that investors have in mind. Looking at different sectors than they did in the past, looking at different countries than they did in the past, and looking at different securities. We don't have only shares and bonds. We have other assets, not necessarily aggressive assets like, you know, derivatives but we have a number of options and other opportunities that we should look for. Again, as I said, be patient and diversify. And diversification is an important issue.
So you mentioned countries. So let's take a look at your country, Italy. And what kind of investors does Italy attract at this moment, both domestic and foreign?
A very interesting question. You know, Italy is a country that is attracting the attention of the world for many reasons. Just before the conference we had with Ipotecarna Banca, the night before, we had this beautiful discussion with a couple of investors who just said, you know, dear Professor Dallocchio, we understand that Italy is attracting a lot of tourists. And Milano, where Bocconi University, your university, is located, is probably at the peak of its popularity, not only European-wide, but worldwide. So if we attract tourists, of course we attract investors that are interested in tourism. So one thing that immediately appears clear, if not blunt, is that people and investors are attracted by what makes Italy famous in the world: arts, culture, and the stream of tourists that is attracted by history, arts, culture, and beauty. Let me add food and beverage. You know, that's another important sector for my country. In general terms, I would like that there are two investors that both domestically and internationally are in love with Italy. One, investors that are attracted by SMEs, small and medium enterprises. You know, we have an enormous number of SMEs in Italy, which is, if you want, let me take just a detour from my main thought. The detour has to do with the fact that the number of enterprises that we have in my country is enormous in comparison with other countries that in terms of dimensions of we are compared with. You know that in Italy only 22% of the working population is employed by large corporations, 22. In Germany it's 55%, in France is around 50%, in Italy 22. This means that the employment is mainly concentrated in SMEs. So good news from a certain standpoint, because it means that we are highly diversified. Bad news from another standpoint, because we do not have that many large corporations, which are, if you want, the solid, safe backbone of every economy. So investors that are attracted by SMEs, investors that are attracted by the typical sectors where Italy is famous in the world for, and I mentioned a couple of them, but also speculators. Also speculators mainly for two reasons. Number one, we all know that the Italian spread in terms of the cost of debt for the government in Italy is around 180, 190, 200 basis points above the cost of Germany, France. This means that Italy is perceived as a risky country in comparison with other countries that are kind of similar animals, if you want. So speculators are attracted by volatility. Speculators are attracted by risk. And that's the reason why we also attract speculators. And then there's probably another reason. I don't know if speculators is the right expression. Maybe I could use another, if you want, more sophisticated expression. People that want to get a good yield, having a short-termism in terms of their strategy. You know what? If you just take a look at price earning or enterprise value, EBITDA, two multiples that are very well known to investors worldwide, and you take those indicators, those multiples in Italy, and you make a comparison with same multiples around Europe or around the world, those multiples are lower, much lower in comparison with other countries. This means that Italian enterprises, other things being equal, are going to be paid less than they would in other countries. So, not speculators, people looking for good yields in the short term, that's a good option for Italy. The only thing that I would like to add at this point is, if it is true that tourism, food and beverage, of course, everything that is related with beauty is luxury items is, of course, typical target for investors, domestic and international. We also have other sectors that are probably not as popular, at least maybe within the investors' world, but not necessarily within the normal people world. The mechanical sector is becoming more and more important and more attractive for international investors. The infrastructure sector is attracting investors from all over the world. We have Australian investors, Macquarie, that is investing in Italy, in Italian infrastructures. We have investors that are gathering in Italy, coming from the northern European countries. These are also sectors that are becoming more and more attractive, basically because everybody knows that thanks also to the European Union resources, we are going to develop important investment plans in the incoming months and years.
So, when we are talking about countries, let's take a look at Montenegro. You mentioned that you've been here lately, and you've been something like 10 years ago. So, who are interested to invest in emerging small country markets, and Montenegro is one of them.
Oh, good. You know, just let me say that I'm in total conflict of interest because I like Montenegro so much that I would say everybody is interested in investing in Montenegro. But let me just keep the role of a professor and let me try and stay solidly grounded on economic rationales. Important source worldwide is, of course, the World Bank. The World Bank creates a ranking of countries that are attractive in terms of doing business with. And I understand that Montenegro, in the ranking of the World Bank, is in the top 50 countries worldwide. So this means that according to a very important source, as the World Bank surely is, Montenegro is a solid place to look for if you want to do business with. What is interesting, by the way, is that, you know, this ranking has different categories inside. And one is the easiness to get credit. And Montenegro is number 15 in the world. Just take my country, Italy. Italy is number 58 in terms of attractiveness for doing business, so behind Montenegro. And in terms of possibilities of obtaining credit, is number 115. So 100 positions behind Montenegro. So an investor that is willing to consider the possibility of diversifying his or her portfolio can find a good environment in Montenegro. And this is just according to rankings, just according to the classification that every year the World Bank publishes. But let me add something more. I just, probably 10 minutes ago, mentioned the word diversification a number of times, just to justify my answer to the question if one wants to put in place a secure set of investments or get the best return. Well, I said a couple of times, go and diversify. Montenegro is an excellent opportunity for diversifying. You know, big European countries are super crowded in terms of investors who want to be there. And I'm also including UK, which is not anymore Europe, not in the geographical sense, but in the political sense. I mean, all these countries attracted the attention of investors that are fighting together just in order to get possibly the best. Montenegro and many other Balkanian countries are absolutely a desert in terms of potential attraction for potential investors. And what I think is that investors that want to get a good yield, relying on solid growth expectations, relying on a solid political situation, even if I understand that, of course, the new government that will be in place is going to have an important task for the future. But a solid political base, a solid social environment, all these are aspects that are reassuring investors that maybe want to do something that is not going as everybody would do to France, as everybody would do to Germany or to Italy or to Spain or to Portugal. So what I think is that there is a strong attraction, and in particular, let me say also sectorially, we shouldn't forget that infrastructures are an important aspect to develop in Montenegro. Energy is something that is going to be more and more attractive. Tourism is an important source of GDP for Montenegro. So there's a number of sectors that can attract investors. One more and final aspect. If there is kind of a mantra, if there is a kind of a totem that has inspired the behavior of banks in the past, that's the ROE, the return on equity. And, you know, I just read a couple of recent publication that highlighted that the banks in Montenegro are performing extraordinarily well in terms of ROE. So I would say also that the banking sector could attract resources because they are well exposed to a good yield.
Excellent. So you were a part of many non-profit organizations. So can you tell me what could investors learn from non-profits?
Thank you for highlighting this aspect. In fact, I'm actively contributing to a number of not-for-profit organizations. One thing that I learned, thanks to my life with these type of organizations, is to be patient. And patience is something that, in particular, in the financial world, is kind of an unknown expression. Nobody's patient. Everybody's always in a hurry. Now, let me mention to you a case that is probably a good way of illustrating what I mean by in a hurry. We all know how private equity operators do their job. Nowadays, they have different attitudes, at least a number of them. But in the past, what I would call, it's an expression that I used before, the good old days. Not necessarily good, but certainly old. Let us go back to the first years of the new century, between 2000 and 2008. PE operators, private equity operators, would normally take over a company, a target company, possibly full of liquidity, possibly mature, no need for big investments to survive, possibly with a possibility of distributing big dividends. They would take over the company, pay out an enormous amount of resources, liquidity, to generate a good yield, a good return for the underwriters of the pieces of the private equity fund, make the target company weaker because with less liquidity, because of dividends paid out, it is weaker, and then merging the beautiful target company with a super indebted entity. So not only the target company does not have any more liquidity, but it's also full of debt, and before it was not full of debt. Why was it so? Reasonably, only because thanks to the gigantic payment of dividends, PE operators would have made happy the underwriters of their quotas. Everybody was in a hurry because the IRR, the internal rate of return for the underwriters, would have been very high. In a hurry for obtaining IRR, which is, of course, an important way of measuring the performance. But if IRR is inspiring your behavior, you know that the sooner the better. So at the end of the day, you have investors of the PE fund that are super happy, and the splendid company that was originally solid, reliable, projected in the future is now weaker, full of debt, and probably limping. Investors should not act like that. Internal rate of return generates hurry, and hurry is an enemy of corporations. So one thing that I would definitely follow in terms of behavior of corporations taken from the not-for-profit organization is patience, waiting until things happen and happen well.
So actually you are talking about long races, and you are also a marathoner.
That's right.
So I want to know, from that point of view, what would you suggest for the investors for the next few years?
Well, you know, yes, I'm a marathoner, and let me say that I'm particularly proud of saying that I'm the European individual who ran the largest number of New York City Marathon. I ran the New York City Marathon 24 times in a row, so it is something that I'm particularly proud of. And I think that my attitude as a marathoner, you're right, it helped me to see things differently. You know, if you're able to survive after 42 point something K, it means that, you know, you have a good preparation. Good preparation is the first ingredient for, you know, having a perspective of surviving in the long term. Of course, if you want to be well prepared for a marathon, as I said before, you must get rid of the sprinter's attitude. You do not want to be concentrated on tomorrow morning. You know what? I hate the quarterly reports. The idea that listed entities are, I would say, in almost all the most important developed countries, obliged to publish every 3 months a report on their performance is crazy. Because this means that managers are basically targeted to reaching certain objectives in 3 months' time. Now, is this sensitive, reasonable, sustainable, reliable in the long term? The answer is no. So let us get rid of the quarterly report. Having said that, managers are very often incentivized to generate returns in the short term. And of course, they are paid on the basis of the results that they generate in the short term. Is this reasonable? An enterprise, a government, a family, they should survive forever. They shouldn't survive for a quarter. So the idea of offering the management team of corporations, but if you want, even politically speaking, to the government of a country, a good yield, a good return, a good personal goodwill, not in 3 months' time, but in 3 years' time, that would be really something to do if we want to get rid of this short-termism that is influencing so badly the behavior of people at every level. I remember my grandfather, who was not a wealthy individual, but he was very proud of being able, on a monthly basis, to set aside a certain amount of money, just for, you know, creating a good shield for the family in the long run. This is something that should happen at the corporations level, should happen at the governmental level, setting aside resources with a long-term perspective. If we incentive managers to perform in 3 months' time and we overpay them for the performance that they are delivering in 3 months' time, this is something that is going to create a big threat for the sustainability of the system in the long term.
So are the investors' expectations actually about technology stocks that you mentioned before too high at this moment? And when we compare the current prices and fundamental parameters, is it realistic?
No, it is not realistic. I carried out a small research thanks to some of my, one in particular, of my ex-students who helped me in this. And I made a comparison between the market capitalization in the United States, simply because it's the largest market worldwide. In the market capitalization of the 8 largest, in terms of market capitalization, I was saying, corporations in 2008, in 2005, and in 2021. 2008 because of the Lehman Brothers crash. But let me concentrate on 2005, that is probably even more interesting. Now, the market capitalization of the 8 largest entities in the US in 2005 was, say, equal to just a simple number, let me say 100. 2021, 100, so the market capitalization of the top 8 firms in the United States is 6 times 100. So it's 600. So top 8 in 2005, 100. Top 8 in 2021, 600. Now, top 8 in 2005, you know how many sectors represented? 6. Oil and gas, large distribution chains, a car manufacturer, a bank, Microsoft, a large technological corporation. Now, strong diversification. You know how many sectors are represented in 2021? Out of 8 companies, 7 are technological companies. So there is an enormous concentration on tech companies. The only one that is not technological is Saudi Aramco, the famous oil firm. Now, strong concentration in terms of dimensions, from 1 to 6. Strong concentration in terms of sector, basically only technological sector. Now, is it just because the technological sector is expressing values, potential developments that justify the fact that 7 out of 8 companies are all technological ones? No. I took a picture that I showed in the conference of the Ipotecarna Banca, took a picture at the screen of Bloomberg at the end of the month of May. And I found it particularly interesting when I highlighted that more or less 20 companies that are listed in the United States, all technological ones, they have an enterprise value over sales, the ratio between the value of that enterprise divided by the sales that they generate on an annual basis, that is above 10. And NVIDIA, which is number 1, is 32. So NVIDIA is now representing 32 times, in terms of market capitalization, of the sales that they actually realize on an annual basis. Is that something, I'm not using the word reasonable that I would like to use, is that something that can be logically projected in the long run? I don't know. So I think that there is this enthusiasm that is probably difficult to justify, but it is there. It happens. It's reality. There is another study that I want to mention. It's a nice study. Let us just concentrate on the S&P 500, so the 500 largest companies in the United States listed there. And sorry if I just mention US cases, but it's just because of the importance and of the dimensions of that market. Now, Let us take the first 500 companies in terms of dimensions in the United States. Let us try and see what is the value of their equity, the book value of their equity. And let us say that it is 1, just an index more than a number, 1. Then let us try and calculate the expected value of the profits that these companies are going to generate in the incoming 3 years. And let us say that more or less it's again 1. So if we put together the value of equity of these listed entities plus the expected value of the extra of the profits that are going to be generated in the coming 3 years, we obtain 2. Do you know how much the value of the S&P 500 is right now? It's almost 5. So 3 is expectations, it's dreams, is hopes and dreams, as the author that carried out this research calls them. And the number of the entities there are in the technological sector are at the basis of these hopes and dreams that create this 3 that hopefully is going to be there forever, but who knows?
So let's take a look at the equity market once again. And what are the key factors which will mostly affect equity markets in the next couple of years?
Now, one is, of course, liquidity. We said that the liquidity in the system is as high as never before. So until we have this source of oxygen that is being injected in the system, we can expect that the equity markets are going to stand at a high level. The question is, are investors happy to stay there with ratio like, let me take price earning, that exceed 20, if not 25? This is a good question. There is liquidity, liquidity must happen. And somewhere, equity markets is an important, of course, harbor to take a look at. We just have to wait and see if investors are going to be happily there with parameters as the one that I mentioned before, PE, that in certain countries and certain sectors exceeds 25. Number 2, debt. You know, debt is something that should be concerning, not because in itself that is bad. That is good, as long as it is sustainable and available. Now, reason why Lehman Brothers went bankrupt and Silicon Valley Bank, a number of 15 years after that, went bankrupt, is not because they had a level of indebtedness that was in itself too high. Simply because once the debt that they were carrying in their balance sheets became mature, became payable, they didn't find other underwriters of the debt ready to make again the debt available. So there is also a question, if you want, of availability of resources. So is the debt that the enterprises, the governments, the families, the bank now enjoying going to stay there forever? This is another question that is going to have an important impact at the equity, at the level of equity market. Because you remember, I said it clearly, a number of investors are using debt for buying shares. So that is, again, another important aspect to keep under the spotlight. Of course, we have to, and it's a crucial question, we have to verify if the correlation among different equity markets is going to remain as high as it is. Now, if we take, let me just use European countries examples. If you take the small market, the Croatian stock market, the Italian stock market, and the German stock market, there is a very strong correlation between these three stock markets. You know, in the middle long term, not necessarily. In the incoming 5-6 months, if the Italian stock market goes up, you can be more or less sure that the same thing is going to happen to the Croatian and to the German market. Correlation is very high. And by the way, the correlation between European markets, US markets, is very high as well. So if all the markets are going to go together as they are doing so far, the expectation is that the equity market is probably going to remain stable, volatile a little, but stable over time, because we cannot expect that the entire world is going to collapse. So if the correlation remains high, it's good news for investors, and the equity markets are going to be maybe a little volatile, but remain stably high. Corporate performances, that's another ingredient that is going to have an impact at the level of equity markets. Corporate performances, even during the COVID period, were not disappointing as many analysts would have expected. And I'm talking worldwide, I'm not saying picking specific countries. And after COVID, performances are still good and incredibly good in certain cases. I'm thinking about, you know, my country. Italy is performing well, but Montenegro is performing well, but it's performing well Bulgaria. I understand that Japan is performing better than expected. Now, if corporations in all these countries are not only maintaining their performances, but maybe even going better, this is going to have a significant, important, remarkable impact at the level of the equity markets. Because, of course, at the end of the day, equity markets represent the expectations on performances. And eventually, last but not least, ESG factors. You know, what I think is that, you know, out there is probably an exaggeration in terms of ESG performances, expectations on ESG performances. Nonetheless, we must say very clearly that a number of investors, large investors worldwide, let me take the case for BlackRock, but I could mention easily, you know, the sovereign investment fund of the Norwegian entities, or they clearly highlight the fact that they want to invest their resources in ESG compliant entities. And this is something that is going to be turned into behavior of investment, not today, not tomorrow, but probably yesterday. So entities that are not sensitive to environmental, social, and government-related issues are probably going to be negatively affected in the incoming, I was saying years, should have probably said semesters, if not months. So that is something that is going to have a very important impact at the level of the equity markets, ESG factors.
So let's wrap up this conversation with this question. How much the rapid rise of the global debt in the last couple of years should worry us?
That's something for which, if I want to reply properly, I think I should need a crystal ball and become the wizard of investors, which is not the case. What I think is that we should be concerned about the rise of debt for the reasons that I mentioned before. Having said that, if we take the level of indebtedness of the most developed countries and so governments of the world, we understand that in the recent years there has been a peak in the overall level of debt of these countries. Do you think that it is possible that the United States goes bankrupt, that Japan goes bankrupt, that Italy goes bankrupt? The answer is no for the entire system. So my idea is that we are getting acquainted with a level of indebtedness that 10 years ago was considered completely foolish, and that now is considered sustainable. So we should be concerned, we should be worried, as you said, but I think that the system, the global financial system, is finding a new level of equilibrium where the fact that the United States have a level of indebtedness that is equal to $30 trillion. 30 trillion is a number that we would find difficult to write in terms of the number of zeros that we have. Is that a sustainable debt? If this question was posed to an MBA student 20 years ago, he or she, they would have laughed at that because they would have said, you're crazy. And now we understand it is sustainable. So we should be probably more concerned or worried. One thing that is clear is that we must have a plan. And the plan for not reducing the debt, but reducing the rate of growth of that is something mandatory.
So thank you for being with us today, and thank you for sharing your knowledge with us.
It was a great pleasure, and I hope to be back to Montenegro very soon.
We hope soon too.